And in addition to that, we had 5 live streamed. In addition to that, we have 5 keynote speakers, starting from University of Bolton to Imperial College London, and then we had a speaker from MIT. And if you recall whatever they said and the presentations which our research scholars they presented, there are a lot of new areas which come at the front, including the role of technology in the business and inside the teaching and learning also. And this we have witnessed over the period of 2.5 years, that technology has gone up in almost all the industries, and which is doing fantabulous now. A lot of companies, they're thinking that the cost is down if we implement technology comprehensively. And we have observed that the few companies which were having bigger places, now they're reducing to their size, the company size and the institution size, to probably 20 to 30%. Why? Because they know that they can implement a hybrid mechanism that can give them a better efficiency and the output as compared to the traditional system. So this is what we had come across yesterday. And starting from today, we are going to have 4 speakers in this session. And after that, we are going to have 4 more comprehensive sessions where almost 84, 86 papers will be presented. The first speaker of today is Professor Irving. Professor Irving is a research affiliate at the MIT Sloan School of Management, and he is also serving as a fellow of initiative on the digital economy of MIT Connection Science. And he is also serving at the board of Stanford Digital Economy Lab. He has worked for the IBM for almost 4 decades. And his primary focus was on innovation and technical strategy. He has been an advisor for the digital strategy at the Citigroup, at HBO, and he is one of the contributors in the MasterCard creation. He has been writing a weekly blogs, which are very popular. IrvingWB.com is the site. If you are interested, you can visit since 20 years. Dr. Irving received his PhD from University of Chicago. And currently he is serving as advisor, consultant, and researcher with the MIT and the Stanford Research Centers. And he's also contributing to the IBM as an advisor. So without further delay, I would like Wasim to play the session.
And Dr. Tahir, we just want to make an announcement, and we request all participants, please turn your cameras on during this inauguration session. Thank you.
I apologize. Just thank you, Dr. Azim. Those who can attend with the video presence, it will be wonderful. So please turn on your cameras if it's possible for you.
Let me start by thanking GCBMS-2022 for inviting me to participate in the conference. I'd like to talk about the future of work in the 21st century digital economy. Let me first say a few words about the digital economy. About 10,000 years ago, humanity started to transition from the hunter-gatherer phase of the previous hundreds of thousands of years to a new kind of agricultural economy. That lasted for about a few thousand years, and then we started to transition from the agricultural economy to the industrial economy around the end of the 18th century, around the 1780s or so, with the invention of the steam engine. The industrial economy lasted until the end of the 20th century, when around the time that the internet took off and exploded in the commercial sector, we started to transition to a new kind of digital economy, and that's where we are right now. So these transitions to new economies are a very big deal because they have happened quite infrequently in the total evolution of humanity. And the digital economy has to continue to advance quite a bit with new technologies in the 21st century. We've seen the rise of the Internet of Things with the physical and the digital world coming together, everything connected to the Internet and becoming smart. We've seen cloud computing continue to accelerate, initially used to make IT much more efficient, inexpensive, but now it's become an absolutely necessity for scaling many kinds of new infrastructures and applications. Artificial intelligence of robotics promises to be the most important technology for the next few decades. And then we have blockchain kinds of technologies, which also hold the promise to increase the security of the Internet and the efficiency of ecosystems of companies and governments working together, as is the case with supply chains. COVID-19, starting 2 years ago, has significantly accelerated the digitalization of the economy and society. Just about everybody who's looked at the impact of COVID-19 absolutely agrees that we have moved on in digitalization by years in a matter of months to be able to cope with and survive the COVID pandemic. Which raises the question, given all these advances of technology and digitalization of the economy, will there be enough work of the future? And this is a very visual way of posing the question. The top picture is a very famous picture taken during the construction of the RCA building, a skyscraper in the Rockefeller Center around 1932. And you see the workers sitting on a beam having their lunch. A few years ago, I went to a conference in New York, right near Rockefeller Center, and they showed the picture on the bottom. And of course, you can see the difference between the picture on the top and the picture on the bottom. So, will there be enough work of the future? This is such an important question that in 2018, MIT President Raphael Reif commissioned a task force to look at the impact of advanced technologies like AI and robotics on the future of work. The task force included over 20 faculty members from different departments in MIT, as well as over 20 graduate students to help doing this research. In November of 2018, the task force released its final report, and you can find that report if you search for Work of the Future MIT. Very interesting report. I recommend you look at it. And just a few weeks ago, the report was published as a book, which was expanded to include quite a bit of additional research during the task force and since the publication of the report. Also very worthwhile to look at. So let me now summarize the findings and the recommendations of the MIT task force on the work of the future. First of all, technological change is simultaneously replacing existing work and creating new work. It's not eliminating work altogether. This has been the case with every technological revolution since the Industrial Revolution, and it is the case today. For example, here is a slide based on data from the US Bureau of Labor Statistics. On the left side, you can see the number of occupations that were in the statistics kept by the Bureau of Labor Statistics in 1940. On the right side, you see the much larger number of occupations that now exist as of 2018. You can see that almost 2/3 of all existing occupations did not exist in 1940. So, as has been the case in the past, over time, innovation and new technologies create new work and new industries, and that's what keeps pushing along the work for the future, because it's hard for us to anticipate now what kind of new work will be created in the next 10, 20, or 30 years. It's easier to look at what work might be transformed or eliminated, just harder to look at what new work will be created. A second major finding is that rising labor productivity has not translated into broad increases in income, and this has led to very serious economic inequality. Why is that happening? Well, you can see that in this slide that shows that since the last 20, 30, 40 years, the wages of people with college education and above have gone up significantly. At the same time, the wages of people with high school education or less have been flat or declining. In other words, the knowledge-based digital economy, starting several decades ago, started to put a premium on education, skills, and learning. And whereas in the 1960s, 1970s, and before, a high school education was enough for a nice paying, high quality job, today it's no longer enough. Today, to get a high quality job, a well-paying job, we need post-high school education, at least a trade, community college, let alone a college degree, professional degree, or graduate degree. The third major finding is very important because it says that the impacts of technological change are unfolding gradually. Instead of coming all over very quickly and the future of work is only going to be transformed in a few number of years, what this says is that we have time. That if we do the right things, we can take positive action to be able to shape the trajectory of change toward the greatest social and economic benefit. And the reason is because these kinds of transformative technologies like steam engine, electricity, the automobile in the past, the internet more recently, and now artificial intelligence take time to distribute themselves and show their impact across the economy. So we have time, but we need to use that time to focus on doing the right things. Let me now summarize the major recommendations for the task force. First of all, not surprisingly, given the increasing importance of skills, training, and education in the digital economy, we must invest in making sure that we don't leave anyone behind, that as much as possible, we are helping people get the necessary education, the necessary skills, and the necessary training so that they can foster economic opportunity and help workers remain productive. And that also means, given the fast changes of technology, that it's not enough to do that until college, say, but lifelong learning is most important than ever to keep up with the continuing changes in technology. We also must ensure that the productivity gains from the continuing advances in technology translate into better quality jobs and economic security for all workers. And finally, given that what really drives the creation of new jobs and new industries are investments in R&D and innovation, we must make sure that those investments continue and actually increase into the future to make sure that we can do all the necessary things to keep developing new technologies and the new jobs that those technologies will make help happen. Let me briefly close by talking about the long-term future of work in this age of increasingly smart machines. Tools have been around since our ancestors first started to develop stone tools to help them hunt better about 2 million years ago. And ever since then, we keep developing new tools, and those new tools help the evolution of the humans, giving us new capabilities with new things that we can do with the new technologies and tools. It's important to keep in mind that no matter how powerful the tools, no matter how presumably intelligent those tools are, humans have motor skills, flexibility, imagination, and creative abilities that, as far as we can see, are beyond the reach of any machine. So therefore, the key to the future is for humans, for all of us, to continue to learn to work right alongside our increasingly smart machines and smart tools, each of us doing what we do best. Thank you very much.
Yeah, I extend thanks to Professor Irving. And now, in case if you have comments about the presentation, you can make comments here, or if you would like to add on something, you can do it here. But if you have questions, you are requested to put the question into the chat box, chat room. So Professor Irving, when he is going to join us, he will answer you your questions. But session is open for the comments in case if you would like to make any comment here.
And as you pointed out, Dr. Tide, some participants, their mics are not mute. We request all to please mute yourself, because sometimes WhatsApp messages, the buzz it is also received in the conference.
The good thing is on Friday, people also send and receive WhatsApp messages.
Okay.
Normally,
Yeah.
Good. Anybody would like to make any comment? Yes.
Yeah,
There is one hand
to the
up.
next, which one?
There's one hand up. Mohammed, would you like to say something?
Okay.
Thank
Yes,
you,
Mohammed.
sir. Stephen has a very interesting topic of his research, and then I found that he has presented and conducted this research in a very good manner. So I have a question, then that question I will mention in the chat so that I can get the answer.
Okay,
Thank
that's
you,
great. Yes, just to tell you guys that I had, and Dr. Azeem and I had almost like 3-hour session with Professor Irving twice to discuss certain things, because he has contributed a lot into the IBM business development, and currently is also serving as a consultant. He has done a lot of contribution in the IT sector. Now moving towards the next keynote speaker of the day, and Dr. Harjud. Sir, are you there?
Yes, I'm here.
Yeah, great, lovely. So give me permission to introduce you to our friends. Dr. Harjud Burma is an associate professor of finance at the Imperial College Business School, London, and a fellow of a National Institute of Economic and Social Research. He is currently serving as associate editor at the Management Science. His research interest includes the impact of beliefs and asset prices, wealth inequality, and the interconnections between asset prices and the corporate financial decisions. His research paper have been published in American Economic Review, the Review of Financial Studies, Journal of Monetary Economics, and the Journal of Economic Dynamics and Control. He has been a prominent keynote speaker into many forums, including Blockchain Economic Forum and the panelist at the Blockchain Economic Forums at many occasions in the past. He was previously as an associate professor at the University of British Columbia, Vancouver. He received his doctorate from the London Business School and MA from John College, Cambridge University. So Dr. Harjud, hand over to you, sir.
Thank you. So it's a pleasure to give this keynote speech. I need to be able to share my screen so I can show you the slides. And the screen sharing is not enabled yet.
Just a second.
Okay, great. So let's do this. Let's go to full screen. So are the slides visible in full? Yeah, is everything fine?
Yes. Yeah, everything fine. Great.
Brilliant. So let's go to the, let's make sure at the beginning. So I guess that the idea is to basically take some of my expertise on asset prices and talk about, I guess, the new normal, how the world has been changing over the last few years and where we think it might be headed. So I'm going to talk about financial markets and government economic policy. And when you think about this, you know, for most people when they study finance, there isn't much emphasis on the government. Okay, there's a lot of emphasis on public markets. You might learn something about private markets, but there isn't a great deal of emphasis on what the government does. However, that's been changing in the last few years, particularly since the financial crisis in 2007, 2008, and also as a result of COVID. Okay, so first of all, why do we care about government policies and asset prices? Okay, and I'd also like to think about why governments have taken actions which have impacted asset prices. And I'd also think about the economic channels via which these government policies actually have their effects on asset prices. And I want to also talk about COVID-19 and the future. So just to set the scene, so asset prices, why would we be interested in asset prices? Sorry. There are many reasons to be interested in asset prices and also their returns. So when I'm talking about asset prices, I mean, you know, the prices of stocks in the stock market, and more broadly, you can think about things as corporate bonds and also government bond markets. So I mean asset prices in the broadest sense. So why would we be interested in those? So anyone who's involved in wealth management, okay, would be interested in asset prices. So if you're a large wealth manager, whether you could be someone like Vanguard or BlackRock, or you could be a smaller scale family office, you're going to be interested in understanding how to make portfolio choices. If you have money, what are you going to invest it in? And these portfolio choices, are based on measurements of expected returns, okay, and in particular, how far these expected returns are from the risk-free rate. So if you think about investing in a risky asset, you'd only be interested in buying a risky asset if you expected the return on that to exceed the return on a safe asset such as a bond. And another point of interest for asset prices, suppose you're not interested in wealth management. If you're a general economist, there are feedback loops between the macroeconomy and asset prices. So clearly the macroeconomy impacts asset prices. So whether we are in a recession or a boom impacts asset prices, and our expectations about the future growth of the economy impact asset prices. But asset prices themselves impact the financing and investment decisions that firms make, okay? They also impact the decisions that money managers and individuals make. And these decisions and their effects will feed back into the macroeconomy. So if firms invest more or less, that will impact economic growth. Okay, so we have this, and economic growth in itself impacts asset prices. So we have this two-way feedback between the macroeconomy and asset prices. And what we've seen in the last decade or so, we've seen the financial crisis, and we have the current COVID-19 crisis, and we also have the crisis in terms of the invasion of Ukraine by Russia. Okay. Now, with the current COVID-19 crisis, we've seen substantial government interventions aimed at stabilizing the macroeconomy. And we also saw that with the financial crisis. And now with the invasion of Ukraine via Russia, we are seeing economic policies basically being brought into place, which will impact, clearly impact financial markets and the wider macroeconomy. So where we choose to buy oil, it clearly is important. And also oil prices themselves are very important for the economy. And we also have the issue of inflation. Now, if we look at the interventions during the financial crisis and the current COVID-19 crisis, it seems that government interventions have had a strong impact on asset prices, okay? And we'd like to basically get an understanding of how these effects work. So why would a government intervene? Okay, why would they do things which impact asset prices? So we generally don't think it is the job of the government to increase the value of the stock market, and make people already quite wealthy even wealthier. The focus of government intervention is supposed to be, at least it's supposed to be, on macroeconomic variables, not asset prices. Okay, so a central bank, it's common for central banks to have an inflation target. If you go on the ECB website, they will actually state explicitly that their job is to control inflation and keep it close to 2%. Okay, if you look at the Federal Reserve, the Federal Reserve in the US has a twin mandate where they're concerned about inflation and unemployment. And you might think that governments clearly are also concerned about GDP and GDP growth. Okay, so clearly governments, even a self-interested government which is just interested in being re-elected, they're more likely to be re-elected if the economy does well. So one thing, now the first bit I'm going to talk about is monetary policy in the macroeconomy. Okay, there was a time when we wouldn't have focused on government policy as a way to understand asset prices and returns. So when I was a PhD student, we did nothing about there was almost nothing about the government and asset prices. So prior to the 2007-2008 financial crisis, the main central bank policy tool was the nominal interest rate, and only the Bank of Japan used unconventional monetary policies such as quantitative easing, by which I mean the purchase of government bonds. However, during and in some cases after the 2007-2008 financial crisis, interest rates hit zero. And we often call this the zero lower bound. So central banks are reluctant to reduce nominal interest rates below zero, where in some cases they have, I think in Sweden. Okay, and we also saw the economic output after the 2007-2008 financial crisis did not return to its pre-crisis trend. So many economies were in what we would call a liquidity trap, which means that you're at the zero lower bound. You can't lower interest rates anymore. The idea behind lowering interest rates is to increase basically consumption. So people say, okay, interest rates are low, I won't save my money, I'll spend it instead. Okay, and that's supposed to boost the economy from the demand side. Okay, so many economies were in a liquidity trap. So you're at the zero lower bound. You can't reduce the nominal interest rate anymore, but economic output is still below potential. Okay, and we call that, what macroeconomists would call that, a negative output gap. Okay, and this is just a graph of what's happened. So it's just basically this is basically a graph of GDP. Okay, in particular, you see it's the log of GDP. So if we look at this graph, it's showing an aggregate of GDP for four countries, four regions: the US, the Euro area, Japan, and the UK. Yeah. So you see this dark blue line. This is actually what happened to the logarithm of GDP. Okay, the kind of weighted average of these four regions. Yeah. So you see basically GDP has gone up, then in 2000, at the beginning of 2008, it drops, and then there is a recovery, but it never returns to its pre-crisis trend. So the pre-crisis trend basically is given by this log linear trend, just a straight line going up. Okay, yeah, and you see that GDP never returns to its pre-crisis trend. Now, and this is just the same graph, but for the UK, looking at real GDP growth, you see the trend rate of growth, yeah, and then you see actual growth. So we never return to the pre-crisis growth trend. And this gap between the trend rate of growth and actual growth, if you add up the area there, that basically will give you the lost output. So between the financial crisis and COVID-19, the Federal Reserve, the ECB, and the Bank of England and other central banks have used quantitative easing. And this has been in an attempt to try and get output back to potential, to try and return to the pre-crisis growth rate. Okay. Now, as you can see, in the UK, quantitative easing has not returned output to the pre-financial crisis trend. And that doesn't mean that QE has failed, because maybe things would have been even worse without quantitative easing. Now, I want to talk about governments, the macroeconomy in COVID-19. What are the aims of government intervention? So governments have been, during COVID-19, governments have used fiscal policy. Okay, and there's also been the issue of monetary financing and negative interest rates. Now, government policy is aimed at the macroeconomy. If you think about them generally, it would be nice to understand under which circumstances government policies actually do impact the macroeconomy and asset prices. And what I want to do is basically show you a very simple framework to thinking about this with some examples based on fiscal policy, monetary policy, and political cycles. So when we think about asset prices, we can go back to basic financial economics. A financial security is just a claim to future cash flows. Now, for equities, the future cash flows are unknown. And if I were to ask you what the probability distribution is for dividends for a particular stock, you probably wouldn't be able to tell me. So even the distribution of the future cash flows is unknown. And prices are just expected discounted values of these future cash flows. And you can see this discounting must be very difficult, because if you don't know what the cash flows are, how do you discount them back? So this discounting needs to reflect, first of all, the time value of money. And that's the simplest aspect of discounting. Okay, that applies, suppose you actually knew what the cash flows were going to be in the future, you could discount them back. Okay, you need to account for the time value of money. However, there's also uncertainty about the probabilities. We don't know the probability distribution of future cash flows. And even if we did, they would be risky. So uncertainty and risk impacts discounting as well. So these three things: time, uncertainty about the probabilities, and then riskiness, So the fact that you may know probabilities, but you still don't know what's going to happen. And then, so discounting is very important for understanding asset prices. Another aspect that's very important for understanding asset prices is expectations. Asset prices are based on our expectations of the future. They are forward-looking. And as we learn and as we gather new information and as the world changes, our expectations about the future will change too. So changing expectations will impact asset prices. So this, of course, means that asset prices are hard to understand. We need to understand cash flows, discounting, and expectations. Okay. Now, the interest rate, nominal interest rate set by the central bank, determines the time value of money, but risk, uncertainty, and the updating of expectations are also important. So the question then is, excuse me, how can government policies impact asset prices? And since we have a basic understanding of how asset prices are determined, we can say there are 5 channels via which government policies can impact asset prices. There is the cash flow channel. Okay, how can government policies impact the cash flows in securities? The interest rate channel, the central bank sets the nominal interest rate, which determines the time value of money. There is a risk channel, an uncertainty channel, and an expectations channel. So governments can do things to impact risk and also uncertainty, but also governments can do things to impact how people update their expectations. We see central banks doing this all the time. Central banks are very careful about managing people's expectations. So which channels matter? So if Keynesian economics tells us that policy is important, however, new classical economics argues that policy is irrelevant. And we have the policy irrelevance proposition, which says that under rational expectations and with no frictions, policy is ineffective. So, for example, the work of Sargent and Wallace, and this appears in various guises. So the policy irrelevance proposition is, you're probably familiar with Ricardian equivalence. You may well be familiar with the Modigliani-Miller theorem. These are all examples essentially of the same thing. However, Keynesian economics says that it's possible to manage aggregate demand in the short run, especially in recessions. Okay, and Keynesian economics went out of favor, but then people have been thinking about it more since the financial crisis. Now, new classical economics emerged in the 1970s, and it was a response to the failure of Keynesian economics to explain stagflation. Okay, low growth and high inflation, which could well return. So economists such as Robert Lucas and Milton Friedman, they basically forced the rethinking of Keynesian economics. Now, in the real world, there are financial frictions, okay? And the policy irrelevance proposition breaks down when there are frictions. So clearly then that suggests policy will matter. Okay, so we know that we can't achieve perfect insurance via trading in financial markets, and technically we call this market incompleteness. We also know there are information asymmetries. So you would assume that a firm manager knows more about the firms than investors. Okay, pension funds, insurance funds, and hedge funds, you'd assume they have more information about financial markets than households. And there are also taxes. Okay, so taxes are basically lead to the breakdown of the policy irrelevance proposition. So because of frictions, government actions can influence the macroeconomy and asset prices, and the world is full of frictions. So that means that the governments have the following policy tools, and we could divide them into 3 groups. There's monetary policy, there is macro-prudential policy, and there is fiscal policy. And we've heard a lot about fiscal policy, so the idea of furlough in the UK. Yeah, so fiscal policy has been a big thing during this COVID period. Okay, so what I want to get you to think about is the idea that these policies operate through different channels. So fiscal policy and asset prices, well, the idea behind fiscal policy is you impact the cash flow channel. You actually can give money to firms, okay, which impacts their cash flows. The way monetary policy operates is via the interest rate channel. And political cycles work via a risk channel, and monetary policy also has an uncertainty channel via which it operates. So I want to talk a little bit about fiscal policy and asset prices and the cash flow channel. So what we see in the data is that in the US, during democratic presidential terms, firms in industries with high government exposure significantly outperform firms and industries with low government exposure by about 6% per annum, but they underperformed during Republican presidential terms. So political cycles impact asset prices. Okay, so that's just a slide going through that. So there's also this interest rate channel. So if you just think, generally we think that if there's an increase in the short-term interest rate, then stock prices would decline. If there's no signaling impact from increasing the interest rate, if you increase the interest rate, then you're going to discount future cash flows at a higher rate, and that should decrease stock prices. Okay, yeah. Now you might think, okay, well, what's just happened now? The Federal Reserve has increased interest rates and the stock market went up, but that's because markets have interpreted that as a signal about the central bank's willingness to fight inflation. Okay, so here we have a graph basically about equity markets, okay, and how the US stock market rises in response to Republican victories. Okay, so this is about political cycles and asset prices. So we can see that whether we have a Republican in power or a Democrat in power in the White House impacts the equity market in the US. And historically, equity markets have preferred Republican presidents. So that impacts expectations. However, if you actually look at what happens to the stock market, the actual realized returns on the stock market relative to the risk-free rate are higher when Democrats are in power, and significantly so, which is interesting. Okay. So we see that the excess return in the stock market is higher under Democratic rather than Republican presidencies. Okay, and there are theories to try and explain this. Okay, based on basically how the idea that public sector workers, Democrats, we think of often Democrats, and they're more risk averse than entrepreneurs, and this interplay between their risk aversions impacts the stock market. The idea is that the risk, if the public sector workers, basically if their risk aversion goes up when Republicans are in power, that risk aversion will basically lead to higher expected returns. Okay. The other thing I want to talk about is monetary policy and asset prices. So we've seen large average excess returns on US equities in anticipation of monetary policy decisions. So just before monetary policy decisions are announced at the Federal Open Market Committee meetings, we see increases in expected returns. And why is this? Well, we believe it's because the announcement itself resolves uncertainty about the future course of of the macroeconomy, and asset prices respond positively to that resolution of uncertainty. So if we're less uncertain about the future, we should basically think, okay, well then we should discount things less heavily. Okay, so here we have a graph showing cumulative returns on the S&P 500 around FOMC announcements. Okay, so you'll notice that the black line here gives us cumulative returns around the announcement days, and the dashed line is on non-announcement days. So this is a very interesting graph. So this graph basically suggests that you just need to be invested in the stock market just before FOMC announcements. So most of the increase in the stock market is actually comes on these announcement times. Okay, so that's a very interesting graph. Okay, so most of the gains in the stock market over a given year actually occur on particular days, around particular times, and those times are when the Federal Open Market Committee makes its announcements. So now I want to talk about COVID-19. So during COVID-19, initially we saw that the stock market basically, stock markets around the world reacted very negatively to COVID-19. But what we've seen since then is basically a strong recovery in the stock market. And you might ask why? Yeah, why has the stock market recovered so strongly? Why has it done so well? So, and you might think about this, is it because of monetary and fiscal policy? Is it because of lockdown policies? And also, going forward, as we see governments reduce and change their intervention policies, what will happen to the stock market? Okay. So here I've done some work on the UK stock market, looking at sectoral differences in asset prices. Okay, so here's just a graph for what happened in 2000, looking at asset returns since the 1st of January 2020. Okay, and what we find actually is, I've done work on the UK stock market, is that a very important factor for stock market performance has been uncertainty. Okay, so here we have cumulative excess returns on the vertical axis, and then we have time on the horizontal axis. And what I've done is I've basically shown this blue line is a 1/n factor. That is basically just an equally weighted portfolio for the UK. Yeah. And you can see that the market, basically the returns on net, on basically we see returns basically very bad, and then we see a recovery. And what I've done basically is look at heterogeneity across sectors and basically decide to say, look, I'm going to construct an uncertainty factor and a risk price factor. The risk price factor you can see here. Okay, so risk prices did basically react, to the COVID-19, but a far more important thing was uncertainty. So when COVID-19 hit, we just didn't know what was going to happen going forwards. Okay. And what we see here is the exposure of different sectors of the economy to basically the 1/n factor, the uncertainty factor, and the risk price. And what you'll notice is that some factors have very high exposure to the risk prices, and some factors don't. So we see significant differences in these numbers. So this is very important, okay, because it tells us that we can interpret COVID-19 as a reallocation shock. Clearly, there was an aggregate effect from COVID-19. Okay. However, but more important for the long run is the reallocation, basically, of economic resources between different sectors of the economy. Okay. So we've seen that some sectors have basically did quite badly during COVID-19 and others not so badly. So that's very interesting. We saw that the technology stocks did very well at first. Okay. And now we see them performing less well. And value stocks basically didn't do so well during the COVID-19 policy. And that tells us about different sectors of the economy. And that's very important for a government because, people work in different sectors of the economy. And if we see that there's reallocation going on, a government could use fiscal policy at the sectoral level. So suppose the government sees that a particular part of the economy is doing very badly, then the government could direct fiscal support at that particular sector of the economy and not spend money on giving money to people who are doing well, have their jobs, and don't need support. So that's quite important. So I want to conclude by saying that asset prices are impacted by government policies. Okay, and in the future, I expect to see more fiscal policy and even more unconventional monetary policy. So, for example, the Bank of Japan has already purchases equities, and we see the Bank of England has been accused of monetary financing. Okay, and some people believe the Bank of England, basically is already engaging in monetary financing by buying bonds issued by the Treasury. Okay, so I hope I've given you an overview of government policies and asset prices and convinced you that government policies do indeed impact asset prices. And I've given you a sense then of how that's important in response to the COVID-19 and so on. Thank you very much.
Thank you very much, Dr. Harjot. It's very detailed presentation, but a very important one. You're right, the government sector is normally ignored. Probably you might be one of the contributor who has took this up, and now the session is open for the questions. Friends, in case if you have any question, please go ahead.
Thank you, Dr. Barmas. I'm Dr. Azim, co-chair of the conference. Yeah, thank you, sir. It is great presentation and a lot of information. Remind my economic background. After my PhD, I was disconnected from economics. I fully agreed when you say the asset prices, they are not the direct objectives of the government. Rather, the larger objective is to bring the stability. And of course, these factors are anticipated in advance, like asset prices. because they are going to take the multiplier effect to the next level. My question is more towards the comparison of the two recessions that we recently experienced. It was 2008, which was financially driven, and the recent COVID driven. The 2008 recession was somehow, rather it was extensively expected because people started writing about that. But COVID recession was sudden, and
Yes.
it was never expected the way it appeared. Now, when we think about this recession, it is a serious issue for the government, and governments needs to come up with effective public decisions. So we normally take two approaches to address the problem. One, we try to find the solution in the past and try to readjust into the past. And second is to try to find the solutions, as you suggested, the unconventional monetary policy, the policies that we need to do. So should we see your model? Is it a framework that can guide us towards the future solution, taking us away from the conventional solution, and can guide the government for the emergent strategic decision making?
Yes. So what I've been doing work on is basically using asset prices at the sector level to tell us in real time, basically which sectors of the economy are more likely to need support. So what I've done in the work I haven't shown here is that asset returns at the sector level are able to predict consumption growth demand at the sector level. So it can tell us basically where demand can forecast where demand is going to be weaker going forwards. And so a government can then decide to intervene provide fiscal support at the sector level rather than at the aggregate level. So rather than giving money to everyone, you can give money to people in certain sectors. Does that make sense?
Yes, yeah, it's fine. So we need to have some innovative solutions instead of the conventional variables or factors that is in the hands of the government. For example, some entrepreneurial solutions, encouraging more private sector into the decision making. So this is what I'm trying to point out.
Right. So in terms of private versus public, as soon as the government is involved, right, this is public support. I guess the point I wanted to make is that the government can provide support at a focused level to particular industries and not all industries.
Right. Yeah. Thank you very much, sir. Thanks.
I think Mohammed Surab has a question.
Yes, Mohammed. Anyone else?
Yeah, hello.
Yeah.
Sorry for late
No
response.
problem.
Sir, you have explained it in a very deep manner. I have a question related to that. You have said that
Mohammed, we cannot hear. Can we hear Mohammed?
Yes, it's okay for us.
Okay.
Okay, sir. We can say that a financial market determine the valuation of asset, and financial market play a very central role for the development of economy. But sir, if financial market is underdeveloped, then it is totally depend on debt financing. So in that way, how government can intervene and can make it possible for the economy to grow again?
So there we have seen, so some central banks have actually purchased corporate bonds, okay? And the idea behind that is to reduce basically the cost of debt financing. So, okay, however, you might argue, what if the corporate bond market is not very active? What can the government do? So there, the government just falls back on the standard tool, the nominal interest rate. If you reduce the nominal interest rate, then you reduce the cost of debt financing. But that's a tool that's well known. There's nothing novel about that.
Okay, sir, I got it.
Okay.
Thank you.
So, yeah. Okay, well, thank you very much. I'm going to have to go to another meeting now. If anyone has any further questions, feel free to email me.
Thank you so much, Dr. Harjod. It was a wonderful session. In case if somebody is going to have any question, we will forward you.
Thank you
from
so
the
much.
chat box. And otherwise, you can directly send email to Dr. Havij.
Thank you very much for your time.
Thank you. Bye-bye.
Thank you, Dr.
Now, the third speaker of the session is a Professor Robert Posen. He is currently a senior faculty member at the MIT Sloan School of Management and a fellow at the Brookings Institution. He has contributed a lot into the academic sector and published many books and research articles. His popular books includes Extreme Productivity, Boost Your Results, Reduce Your Hours. And his recent book is on productivity when working remotely. He has published many articles in the Harvard Business Review and Sloan Management Review. In 2004, this is his biggest contribution in the world. In 2004, Bob became the executive chairman of MFS Investment Management, which now manages over $400 billion mutual fund. During his time, the worth of the company became double. During his distinguished career, Bob has actively participated in the government, business, and academic sector projects. Prior to joining MFS, he was the vice chairman of Fidelity Investment and the president of Fidelity Management and the research company. During his 5 years as a president, this company assets were increased from $500 billion to $900 billion. In late 2001 and 2, Bob served as a President Bush Commission to strengthen Social Security, where he developed a progressive plan to make the system solvent. In 2003, Bob served as a Secretary of Economic Affairs for the Massachusetts governor. Bob is currently chair of Leadership Council of the Tax Policy Center, chair of Advisory Board of Agility, and the director of AMC World Bank Group. He frequently writes articles for the Market Watch, the New York Times, Harvard Business Review, Wall Street Journal, and he is also publishing many books, including Financial Crisis, which was one of the best-selling books. Bob graduated with a summa cum laude from the Harvard College and holds a degree from the Yale School also. He has been advisor to the Secretary of Treasury and the Undersecretary of the Health Affairs at the Veterans Administration. It was a very comprehensive interview we have conducted with the Bob, and that is recorded one, which we are going to display to you guys. And in case if you'll be having any kind of questions, you can put them into the chat box. Those will be conveyed to Bob for the with the request to answer them. But in case if you would like to comment on the presentation and the interview session, so you can comment live here. Wasim, can you please display?
Well, thank you for having me as a speaker at your conference. I want to talk about remote work based on my new book, Remote Incorporated, which is published by HarperCollins. What I think is interesting is if you read the press, there are many CEOs who are saying they want their employees to come back either full-time or close to full-time, like 4 days a week. By contrast, if you listen to the voices of the employees or look at their surveys, they don't want to come back 4 or 5 days a week. Most of them only want to come back 2 or 3 days a week, and some of them want to stay remote completely. So it's an interesting question as to why there's such a divergence of opinion and why it is that the CEOs are so keen on people coming back to their offices. So in talking to CEOs, I've figured out that there are a few reasons why CEOs think that it's really important for workers to be in the office. First of all, they think that the innovation, the ideas that are generated by people being in the office through informal interactions are really critical, and they're worried about losing that innovative thrust. A second reason, which is sort of related, is they feel that lots of work that their people do is collaborative in nature, interdisciplinary, and they want that cross-fertilization. And they're very afraid that if you have people working mainly remotely, you'll lose that collaboration. A third reason is what I call the apprenticeship model. They feel that the way people learn, the way young people learn, is by being in meetings and watching their seniors relate to clients, relate to other people. That's what's sometimes called the apprenticeship model. And so they're worried about losing that. And fourth is culture. That's a point that many CEOs make. It's a diffuse concept, very squishy, but each company feels that it has a unique culture. And the CEOs believe that to maintain that culture, it's necessary for people to come together in the office. So my take on this is pretty clear. I think all of these reasons have a measure of validity. They're all things that are legitimate concerns of CEOs, and they're all processes or approaches that benefit from having people physically together. But that does not mean that employees need to come into the office 4 or 5 days a week. Many of these processes can occur through what I call a hybrid model. A hybrid model meaning some days in the office and some days at home. For example, if you want to promote innovation, people aren't going to be focused on innovation 5 days a week. If you have them come in 2 or 3 times a week, then they can have these informal interactions. And then we should realize that it's possible to organize the remote workplace in a way to promote innovation. You can have brainstorming sessions where anyone in the team can call a session and have everybody come and throw around an idea. So in short, the CEOs are right to be concerned about these issues, but that doesn't necessarily mean that people have to be in the office 5 days a week. They need perhaps to be in the office a few days a week, and then to organize the remote workplace in a way that supports and deals with these concerns that they have. Let me stop there and take some questions that we should be able to discuss about the remote workplace, the hybrid, and these sorts of issues.
Yes, Professor, you said the hybrid model. That's the lovable concept. Everybody would like to go for that. But one challenge companies are facing, they're thinking to bring the people back because they would like to have the same traditional life which they had before. In spite of this, that they have realized that in case if they do a remote working, there are a lot of costs they can save. So what is your advice to those kind of people who are still thinking to have the traditional life back at the workplaces?
I think that everyone has to realize that the world has changed and it's changed permanently. So the idea of having the traditional pre-pandemic model is just not going to be workable. So I think what those people should do is focus on the hybrid, which I believe will be the major mode in the future. Of course, there'll be a few firms that will be totally remote, and then there are firms that have to be mainly in person because, say, like in the restaurant business, it's a service business, and they're physically there. Interestingly, something about half of the workers surveyed are in jobs where they have to be physically present. So what we're really talking about is knowledge workers, professionals who can be anywhere. So we're really talking about that half of the workplace. So half of the workplace is going to have to be physically present for personal service like restaurants, or for manufacturing where they have to be on a floor, or for delivery like Amazon workers who are actually in trucks. But on the other half, I think we're going to see a hybrid structure in which workers come into the office 2 or 3 days a week. Now, one of the things that's an important question is who determines the optimal design of the hybrid structure? Some people would argue it's the CEO who should make pronouncements on high that apply to everyone in the organization. Other people have argued it should be up to the individual. So my take on this is different. I think that the appropriate decision-making unit is the team. The team is the one that really works together, and different teams in the same organization operate totally differently. So for instance, in a financial services firm, you have investment analysts, they're a team. You have the supporting IT people, so that's a very different team. Then you have marketing people who go out and try to get business from clients. And then fourth, you have customer service people. So each of these teams operate very differently, and it doesn't make sense for the same rule to apply to all teams. They ought to think of them differently. And then the other thing is, I believe that in the hybrid structure, when you have teams, they can alternate physical space in an office. Some people argue that you should just allow people when they come in the office to pick whatever desks they want, sometimes called hot desking. But I think that's really not very comfortable for most people. Most people want some place where they can put their stuff, where they come back and they have the same place every time. So what I advocate in the hybrid structure is to have two teams sharing the same place. You want all members of the team to come into the office on the same day. That's where you promote the innovation, the collaboration that you're looking for, the apprenticeship model. So if you have one team that comes in on Mondays and Wednesdays, and another team that comes in on Tuesday, Thursday, and Fridays. So everybody has an office, but they share it with someone else. So that's much better than hot desking. And then, of course, from the company's point of view, you can reduce its rental costs, its real estate costs by 30 or 40%. So that's a big win for everybody.
Thank you, Professor. Next question is that, as you said, that people can share the office space, and some teams can come in first 3 days of the week, and some teams can come later for a few days. What is your say about a question that gets raised here about a privacy? In case if somebody is going to share office with the other people, there will not be a challenge of privacy, and how we can manage that.
That's a good question. So we're talking about sharing an office in which one person will be there 2 days a week and another person will be 3 days a week. So they won't be there at the same time. But the advantage of having your work materials and all your materials there, someone else may come in, and that could raise a privacy issue. So I think the answer is you want to sort of have special files, one for each person. And so they can keep in that file, in a locked file, the materials that they think are confidential, where they really want to have privacy. Also, from the point of view of the computer, the fact that other people are using the same desktop doesn't mean that they're going to have access to the information of the other person. So I think there are ways to deal with these privacy issues that are quite workable.
Professor, some of the CEOs, they're really thinking in a concept that if we ask our people to work from home, they might be having some social issues in a sense that one person is spending majority of his time at home. They're exposed to the family challenges and other activities which happen at their residential in a larger number as compared to if they are coming for 5 days to the work and they're spending 2 days with the family. So what is your say on it? So how it will impact the social life?
I think it's another good question. So I think there are several aspects of this. One is that some people who work remotely complain that they feel isolated, they feel lonely, they may even get depressed because they're isolated. So there are ways for the team leader to promote interaction and to have social activities that are remote, that are not based on a business agenda. So we've seen various companies organize cooking lessons, games, charades, various things in which people who are working remotely get a chance to interact with other members of their team and start to develop the bonds that are important. Another thing is you can encourage people on your team to talk or even meet with other members of the team outside of the office. So people can have coffee dates in which they meet with other people in the teams, or they could have phone calls or these sorts of things. And then the other aspect of privacy is how do you cordon off the workplace from all the other personal aspects of being at home? Well, to the extent that you can have a separate home office, that really gets you a long way toward that. But some people don't have that luxury. They're in a smaller space. So I advocate that they have at least have their own desk and have a separate segregated space that's slightly off the beaten path. So it shouldn't be right next to the kitchen or next to the TV room. So it should be a little off to the side. And there should be an agreement, especially when the kids go back to school, that they're not to be disturbed and that they're, when they're working, they can hold out a sign or do something that tells the rest of the household that they don't want to be disturbed. But, people are much more tolerant. I've been on a lot of Zoom calls where a child will come in and talk to the person that I'm talking to. Nobody bats an eye about that. So I think people are pretty used to some degree of family intrusion, and it's not a big deal.
Okay, Wasim, go ahead, please.
Okay, Professor Bob, this is a tremendous topic. I just want to ask this thing that there is one concept of work-life balance. So when employees would be working remotely and then they were coming back toward the office, so would it disturb their life patterns in any sort of manner? Because a human mind might be tuned, like they're going to work like 5 days a week, but shuffling from remote to the office, and would it impact in any way the work-life balance space?
Well, I think that most people can handle being in the office a certain number of days and being at home a certain number of days. Many of them travel a certain number of days in the week, so they're already used to that. So I think they can deal with that rhythm. But I think that for a lot of people, they complain that when they're working remotely, that they're not sure what the boundaries are. They love working remotely, partly because they don't have to commute And so that saves them a big slug of time. But then they say they feel like they're on 24/7 because they're working at home, and then there are no boundaries in an office. They come there, they commute there, they there for a while, they come back. So I recommend two things. One is, from the individual's point of view, they need to establish what I sometimes call the ritual of the day. Since they don't have the structured ritual of coming into the office and then going home, and that sort of a structured day, they need to create their own structure. So maybe they decide they eat breakfast, they have a cup of coffee, they then go through certain things, and then they start to work. And they take a certain lunch hour every day they're at home, so that things are more structured. If you don't structure your day, then people complain that it's sort of all, they wind up feeling like they're working all the time. And they're sort of a little ill at ease because they don't have a structure. The other thing is that the team leader needs to be proactive and establish the ground rules of work. So I advocate that team leaders, in terms of ground rules, say, here are the hours that we expect you to be answering your emails or your phones or your messages. But after this amount of time, we don't. And secondly, they might say, if you get a message from a client, we expect you to respond within an hour or two. But if you get a message from the team member that isn't marked urgent, you can respond to it within a day. So you've got to tell people when it's legitimate for them not to be on call. And that's critical to helping them feel like they have a structured day and still have a structured weekend, even though they're working remotely. The last thing I want to talk about is success metrics in terms of team management. So most people who are running teams put out objectives for the team, but I strongly advocate that they go further and they get the team to agree on success metrics. So if you have like an objective like, let's promote customer service, let's increase and improve customer service, that's a legitimate objective that most people would agree with. But the question from the team's point of view is, what does that actually mean? Does that mean that we're trying to reduce errors in the transactions we have? Does it mean that we're trying to have more customer subjective satisfaction through surveys? Does it mean that we're trying to increase revenue by having customers do more transactions with us? There are lots of different ideas and concepts, all of which are valid. So what I advocate is that in any team, that after the statement of objectives, that there be an agreement on success metrics, that they ought to be specific and they ought to have time targets with them. So then at the end of the period, we say, we know what the success metrics are. We know whether we're going to be successful. Here's how we're going to measure this. And in my mind, success metrics are really critical to the effective operation of the teams for three reasons. One is they clarify what the objectives are. They clarify what the team is trying to do. Second of all, they help the manager avoid micromanagement, because he or she knows what's the results going to be at the end of the period. And third of all, they promote work-life balance, because once you have success metrics, then it's up to the employees, the team members, as to how and when they get these success metrics accomplished. And it's that flexibility and that autonomy that they have that promotes job satisfaction and also gives them a chance to have better work work-life balance.
Thank you very much, Professor. It's success metrics really is something really new. I never thought about it. That's
Good.
amazing.
Okay, thank you very much.
Thank you. Thank you, Professor, for your time.
Okay.
Looking forward to see you again.
Thank you, Wasim, for displaying the presentation. And the same pattern we are going to follow. And in case if you have questions, please do put them into the chat box. And Professor Bob, once he will be joining us, might be in the late evening today, so he might respond the questions. And in case if you would like to make any comment, a quick comment you can make, and then we can move towards the last but not least keynote speech of today. So if no comments, Dr. Azim, with your permission, I would like to invite the last speaker.
Yes, sir. Good, sir.
Yeah, last keynote speaker of today, but not the least, is from Professor Steve Spear. He is a doctorate from the Harvard, where disruptive innovation thought leader Clayton Christensen was one of his dissertation advisors. He is a popular name. And he has also done masters from MIT. Currently, he is lecturer at MIT Sloan School of Management, where he is teaching to the graduate students and training executives. He has advised several dozens of graduate theses. He is also a senior fellow at the Institute of Health Improvement and associated faculty at the Harvard School of Public Health. Spear has published in Harvard Business Review, Sloan Management Review, U.S. Naval Institute Proceedings, and the Journal of Nursing Administration. Spear's research has had broader application and the impact, serving as the basis for operating systems like the Aloka Business System and the DTE operating system. He has been advisor to the Secretary of Treasury and the Undersecretary of Health Affairs at the Veterans Administration, a Chief of Naval Operations, a Chief of Naval Research, and the Director of Army Rapid Equipping Force, and the number of operating leaders. He has been a prominent advisor, consultant, researcher, and the mentor for different organizations in the past. Wasim, I would like you to display the recorded session.
Greetings from Boston. My name is Steve Spear. I'm a senior lecturer at the MIT Sloan School of Management and author of the book, The High Velocity Edge. Thanks for taking time with me during this conference. The new normal. Why are we even talking about a new normal? Well, the reason is the old normal has been thrown up in the air. New technology, new economics, new strategic environment, new politics, and of course, with the added mix of COVID disrupting everything even further for the last 2 years. What that says is that our old normal, the one we were familiar with, doesn't give us the experience, it doesn't give us the precedence, it doesn't give us the mental models to figure out what to do going forward. So, given all that turbulence, what do we need to do? Well, one can imagine that for some people, in a period of great uncertainty, what do they want to do? Because it's uncomfortable for them. They want plans, they want detailed plans, they want comprehensive plans, they want far-ranging plans, 1 year, 2 year, 5 year plans. But there's a basic issue with plans. Plans are essentially fragile. And just to illustrate the point, let's step out of the economics, the business, the political, just to the biological. So there's a US cross-country skier, guy's world-class, named Chris Freeman. Chris has the distinction not only of being a world-class athlete, of which there are very few already, but he's a world-class athlete with type 1 diabetes, which is even fewer. Now here's what happens with Chris. Every single day for him, like all diabetics with type 1 diabetes, is that they have to have a very planned existence. They have to figure out what their activities will be through the day and, by the minute, by the hour, what their energy consumption will be, what their insulin dosage will be. And they have to stick to that plan with really a tremendous amount of rigor and discipline. Otherwise, things go all sorts of kablooey, hypoglycemia or hyperglycemia, whatever else. Stick to the plan. Well, anyway, here's Chris, 2020 Olympics. He's in the 30-kilometer race. And he's halfway through, and there he sees he's in second place, and you can see the gold medal contender right in front of him. And what happens? Well, he's a world-class athlete, so what does he do? He accelerates. He's got a shot at gold. The other thing, of course, it's protective because if he slows down, he might slip from silver to bronze and maybe even out of metal contention. But what's the problem for Chris, type 1 diabetic? He hadn't planned to accelerate at the 15-kilometer mark of this 30-kilometer race. And it threw everything out of whack. What happens? He starts accelerating because he has to stick to this plan. He goes hypoglycemic. His blood sugars start crashing. And Chris, instead of catching up to the guy in first place, he flops down on the snow, hypoglycemic. Now, fortunately, a German coach recognizes what's going on, races over, gives Chris some sugary drink, raises his blood sugar level, and he gets back into the race to finish, but in 45th place. That would not have happened to someone without type 1 diabetes. What would have happened then with the dynamic system of blood sugar control and exertion and all of this thing and that thing, all the biological processes either would have allowed that racer to catch up and get into first place, or to know to slow down and not hit the wall and crash. But Chris didn't have that luxury of these dynamic systems making these adjustments when he needed. The Soviet economy was a centralized planned economy with these elaborate schedules of what to make, when to make, what to sell, at what price, this and that. Hypothetically, I'm sure it was very appealing to the Kremlin to think that they had so much control and so much foresight over what was going to go on. What's the problem? Well, weather, harvest, demand, needs. You're trying to have this highly planned system in an environment which is inherently unstable and unpredictable. And they have an unadaptive mechanism for a highly demanding system. And we know how that story ends. So what's the punchline on planned systems? Planned systems promise stability and predictability, but here's the thing, they only work in situations of extreme stability and predictability. But we're in an environment now which is neither stable nor predictable. We need something else. What I want to offer is something else, is dynamic systems. Systems which are characterized by their ability to recognize problems, to solve problems, to have this dynamic learning, and again, not just at the center, but distributed around the edges. So we've already seen, when we already should have some inspiration for that, because here we're in a period, even before COVID, of extreme technological change, political change, economic change, on and on. And what we've seen is that some organizations have been wildly successful in managing during this period of great instability and great change, and others have really suffered and haven't kept pace nearly at all. So what's going on? What's going on? Well, given the time we have, just one example is that those who have excelled have figured out how to take advantage of the intelligence distributed throughout their whole enterprise, create the conditions in which people, all people ideally, can give full expression to their inherent creativity towards some common purpose, and they win. And those organizations which have not created the conditions in which people can give full expression to their creativity, they've lost. Let me give one example of one of the strategies, at least, to allow this full expression of inherent creativity. What we call is center out versus top down. So think of this, and it's maybe familiar to many of you. You've got an enterprise, it's got distributed operations, a branch over here, a factory over there, an outlet over here, a hospital over here, whatever it is, you've got distributed operations. And you have three alternatives amongst which you can choose in terms of how you manage those distributed operations. Alternative one, let them do what they want. It's kind of a portfolio approach. You let the managers and the employees at those distributed operations do their own thing without much guidance from headquarters. At the end of the day, maybe it's the end of the quarter, the end of the year, you just tally up the results and you give out your gold stars, your silver stars, your bronze stars, you win, you lose, that kind of thing. Another alternative, this is alternative number two, is that at headquarters you say, oh, hold on, we don't want any of that kind of chaos. We want control. So what we're going to do is we're going to develop policies. We're going to create procedures. We're going to create plans. And until we do that, we don't want you to do anything. But when we do, we're going to push those out to you. And your job, when we've given this command of the plan, the policy, the procedure, is you comply. And we're going to audit you to make sure that you're following it well. Now, we all know how that happens, is that even under normal circumstances, as we saw with Chris Freeman, as we saw with the Soviet economy, kind of this top-down policy, procedure, plan, command, control, compliance, audit thing, it doesn't work all that well, even when the turbulence is kind of a mild, quote unquote, normal turbulence. When things are really up in the air, it doesn't work well at all. So that gives us our third alternative, and this is the one we want to talk about a little bit further, is push out to the edges the opportunity to fully engage the brain power that's out there, to experiment, to explore, to try things. And what does the center do? The center has a purpose here. The center there, first of all, create the conditions, create the culture where this experimentation, this exploration on the edge, it's the thing to do. Push out whatever is best known that the center has privileged access to, push that out, and then do the drawing in of lessons learned, individual lessons, so they can be synthesized into an ever better shared best understanding of how to proceed. We've had examples of this, we've lived through them. So for example, when COVID hit, this is, in the US, we became really, really aware of it, February, March 2020, when things really started to shut down. The government said, all right, we got to shut down now because we don't know how this disease vectors and on and on. Said, but we'll start opening things up slowly when we have tests, so we know who can go out and who has to stay in. And when we have vaccines, when everyone can go out with more normalcy to their existence. Well, one would expect that it's easier to test than to vaccinate for COVID. And except that wasn't the experience we had in the United States. In the United States, it took a very, very long time to get a meaningful test. And the vaccine, on the other hand, people were predicting back in March 2020, you got to wait a year. This will come in 2022, maybe 2023. Where did we get the vaccine? In a year. It was amazing. And why is that? Well, it's this sort of top-down, center-out difference. The planning, the control approach versus the distributed experimentation. A few brains in the game versus many. In the case of the Centers for Disease Control, they said they were responsible for the test. They said, look, we're the world experts in infectious disease, which is true. And because of that, this was the mistake, we're going to be the ones who develop the test. You all wait for us. Once we develop the test, we're going to push it out. We'll tell you what the test is. We'll tell you how to test, when to test, who to test, all of that. Here's the problem, that they had an imperfect understanding of how to develop a test. Of course, it was a new disease. So what ends up happening, they go down a dead end, but they got no backup. They got no other recourse. So I had to start again. And what happened on the vaccination side? The Food and Drug Administration, they said, look, we're the world expert on issues related to safety and efficacy and testing for all that. And we got a huge amount of knowledge about disease just in general and vaccines in general. But look at all the brain power and all these pharmaceutical companies that day in, day out, they make vaccines. So what did the FDA do? They said, you all, everyone try and come up with a vaccine, figure out what'll work, what won't work. And we'll pull in the best ideas and then cycle them out again. It was a center out, distributed, more democratic, more inclusive approach to experimentation and exploration. And we had this recurring. We had it with schools and whether schools could open or not. The school systems where the chief said at headquarters, wait for the policies, wait for the procedures, wait for the plans, which will push out command, control, compliance, and audit. They stayed closed a year and a half. The schools that, the school systems where the center said, look, we need everyone's brains involved to figure out how to mask, how to socially distance, how to run a class at in-person, hybrid, this thing, that thing. They were able to open up within 3-6 months, something like that. It was fantastic. Anyway, where are we? This center-out approach has all the advantages of getting everyone's brain into the game where the top-down doesn't. This dynamic learning approach gets everyone's brain into the game where the planning, the policy making, the procedure making approach, it doesn't. But it does come with a risk, right? Because if we're the type of folks who like to plan, we have to have control. We like to feel that we're in charge. The planning approach is very, very attractive. It's not effective, but it's very attractive, which means that we as leaders have to internalize the idea that we aren't going to be in a position to tell people what to do. We're going to be in a position where we have to cultivate a certain set of creative behavior amongst people. Maybe we're not used to doing that before. But here's the promise, right? It works. It works. It works for the schools that opened. It worked for the FDA with the vaccination. It worked for Google. It works for Amazon. And the alternative, it doesn't work for those other folks. Anyway, I just want to say thank you. I hope these ideas were helpful. I'd like to hear back from you as to what worked, what didn't work, et cetera, and so forth. And Be safe, be well, and good luck. So long from Boston.
Thank you very much, Steve, for this wonderful presentation. And in case if everybody is having, anyone is having a question, please put it into the chat box. Or if you would like to make a comment, a quick comment, you can make it. Otherwise, we can move towards the presentation sessions. And for that, we need to move to different rooms. And there were 10 minutes allocated for the break. However, we have already utilized 6 minutes, and 2-3 minutes. If you would like to take a break, you can please. And after that, we will begin the session 4, which is related with the human resources, and next session, theme 2 is related with marketing and law, and theme 3 is related with economics and business. Yeah, it's 2 minutes break. And meanwhile, let me confirm if the presenters are there. Dr. Hussain?
Dr. Tahir, I'm leaving to the.
I'm here.
Dr. Tahir, I'm going to leave team 3 because I think participants are joining there.
Okay, so you need to go to theme 3. Okay, great.
Because
please go ahead.
I was assigned to team 3, right?
Theme 3, correct. And Dr. Sam, you are assigned to theme 1, and Dr. Muftu.
Which is HR, Dr. Tahir?
HR, yes. Wasim is going to transfer you there. See, role of chair is to give 10 minutes, 12 minutes in case needed, to the presenters, followed by 3 to 5 minutes question answer session.
Okay.
And try to ensure the timely beginning of the presentation, the conclusion. That's
Sure.
the role. And later we will discuss, in case if there is a problem, we will keep moving into different themes and different rooms we will be coming. If we encounter any problem, we will be there to facilitate you.
Okay, thank you.
Welcome, sir. Wasim, you can start transferring people now.
Yes. Okay. So everyone please
First,
type which room do you want to go to?
Yeah, first, please transfer the chairs. Dr. Azim 3, Dr. Hussam first.
1.
Yeah, first 1. And Dr. Mufutao Popola.
Yes.
Yes, and please transfer Dr. into, sorry.
Dr. Maftao 2, which session?
Theme 2.
Or Dr. Hussain, okay, theme 1, right?
Theme 1.
Yes.
Okay, done. And
now I can tell you the presenters. Yes, Mr. Ayman, theme 1. Sandeep, theme 1. Sandeep, are you here?
Sandeep.
Muhammad 1059.
Sorry?
Okay, go to the next. Muhammad Saeed, theme 1. Muhammad Usman, theme 1.
Usman transferred, Maimuna transferred. Okay.
Miss Masha, are you here? So theme 1. Now for theme 2, Nazira.
Nazira, theme?
Theme 2.
Okay.
Legman, theme 2. Sakina, theme 2. Tian, theme 2. Paranav, theme 2 also. Hello.
Okay. 1114 Tian. I am unable to find the name Tian. Okay. on 1114. 1114 wants to go to theme 2. Theme 2 already in the theme 2. Okay. Stir, done. Theme and done. Yan, session 4, theme 1. Yan. Anyone else? Please let me know which theme do you want to go to. Session 4.
Theme 1, please.
Put me in theme 2.
Sorry, can you say it once again?
I'm supposed to be in theme 2, but my name will be showing as P. Kumar at sct.ac.ae.
Okay, so you want to go to theme 2, right?
Yeah.
Okay, done.
I'm in the theme 4 HRM. The first presenter, Ayman.
No, Dr. Ayman, it's session 4 and it's theme 1, right?
Yeah, the first presenter, HRM.
Okay, Dr. Ayman, I'm transferring you. Done. Okay, please let me know which theme do you want to go to. Either write it on the chat or tell me this. Theme 3, 10.
In progress.
Please, okay, Ayman, Dr. Ayman, I had transferred you. Okay. Theme 3.
Yes, this is Dr. Ayman. I'm here.
Yeah, I have transferred you. Maybe you're on your other device, right?
I don't. I'm using the laptop. I don't know which room you transferred me. Yeah.
Ayman, first one.
Yes, sir.
Wasim, can you please transfer Ayman again to the first one?
Yeah, done.
Okay, great.
Yeah, my name is Aminu Sani. So I don't know which term will I. So will you transfer me to term entrepreneur?
Mr. Aminu, do you know when you have presentation?
Yes, I have done my own presentation since yesterday.
Oh, fantastic. So which one you would like to join now?
Term entrepreneur.
Entrepreneur, we don't have now. We have economics, marketing, and HR.
Okay, put me on marketing, please, sir.
Great. No problem.
Okay, sir. Thank you, sir.
Thank you.
So marketing is the second one?
Yeah, marketing is 2. Let me see. Respectable professor, I can see the name India written. Hello. Madam, your name is coming India. So I'm so sorry, I can't recognize you with the name. If you tell us, we can transfer you to a relevant session. Which one you would like to go? Okay, Rabi.
Yes, Doc. I would like to go to entrepreneurship.
Okay, economics 3.
Economics,
third one.
Right?
Yeah, third one. Aminu, back? You're back again?
Yes, I am back.
I think Dr. Aminu would like to stay with us here in the main room.
Marketing room.
Marketing, okay. Marketing is 2.
Marketing is 2. Done. Dr. Aminu, I transferred you. You must receive the message.
Garishma, Miss Garishma. Dr. Muhammad Alam.